All right, everyone. Welcome to another episode of Advisor Visionaries. I'm your host, Litan Yahav, and with me is the one and only Jim Pfeifer. I am so excited to have you on the show, Jim. You're like one of the first podcasts I've ever done, and so I'm excited to go full circle here on the podcast network. Thank you for coming on.
Thanks for having me. I'm super excited to be here.
Just for context, I've been following you guys for a while, and when we kicked off Visor, one of the first people that, I don't remember if someone introduced us or I just reached out to you, but I just remember like it clicked and I really was impressed. One, just by you as a human being. We were just like so down to earth, direct and interesting to talk with and kind. And also from a professional, like you build Left Field Investors with some amazing people, and that grew, and obviously where we're at today. And when this podcast comes out, it'll be old news, but I mean, it is new today. And so I'm just really excited to have you on the show. Why don't we, before diving into, obviously where we're at, I want to know like the origin story of Jim Pfeifer, like before everything.
Before everything. Okay. So, well, I grew up in Anchorage, Alaska. We're not going to go all the way back to that whole story, but I grew up in Alaska and, came to the States we call it the States or lower 48 to go to college in Ohio. I always wanted to be in finance somehow because I really wanted to be a teacher, but teachers didn't make enough money and I knew I wanted money. So I just worked in business. My first job out of college was in reinsurance and I really enjoyed that. And the part I really enjoyed most was mentoring people and education. And that's kind of a theme throughout my journey, as you'll hear. After 9/11, the reinsurance industry completely changed. It was just such a bummer. And I'd always told myself if I was ever working in a job I didn't like, I would leave. And so after 12 years of the reinsurance company and traveling all over the world and living overseas and all of that, I just quit one day. I picked April 1st to quit, so no one believed me. They thought it was an April Fool's joke. But I said, you're never going to see me again, and they haven't since. And then I kind of took a year off just to kind of figure out what I wanted to do. And then I did what I'd always wanted to do, is I became a teacher. And I taught in Columbus City Schools, which is kind of a inner city school district for kids that just really had tough stories. The kids were amazing. They worked so hard, they tried so hard, but it was just difficult because they were so far behind that they just couldn't catch up. And it was really, teaching is a really difficult job. I did it for 7 years. And after that, I switched and I became a financial advisor. And that's where I really got into real estate, interestingly, because at the same time, we couldn't sell our house. And so we rented it out. And when you become a financial advisor, they teach you all about money. And I thought as a finance major in college, and I'd invested in mutual funds and the stock market as soon as I could. Out of college, I was investing always. So I thought I knew everything there was to know about money. And it was interesting is the more they taught me about money as a financial advisor and having a real estate asset on the side, I realized, oh, wow, all these concepts, they apply much better to real estate than they do to these paper assets that you're having me sell as a financial advisor. Slowly, I got more and more into real estate and was spending more of my time as a financial advisor sitting in the office doing my own real estate stuff rather than doing the financial advising that I wanted to do. But I enjoyed the teaching aspects of trying to teach clients, hey, here's some things you can do with your money. But I didn't like the sales aspect. So eventually, once I got my active real estate portfolio to a good point, I left there and became a full-time active real estate investor. And I was terrible at it as far as managing the asset. Fortunately, it was in a great time where anybody, including myself, could buy assets and they just go up in value, double and triple with no work into them. And so that was great, made some money, but I realized finally I found syndications or passive investing. And I thought, okay, that's for me, where I hire an asset manager to manage the asset for me. And so now my job is to evaluate the asset manager. And that's where Left Field Investors was born. Because as an active investor, I'd started a community in Columbus, Ohio of people that just to network and meet people and get deals done. And when I wanted to go into passive investing, I wanted to learn from other people. So I thought I'll start a little mastermind of 12 people. And we did that and started that in March of 2020. And our first meeting was canceled because COVID shut the world down and we couldn't meet in person. We went on Zoom, and that is where Left Field Investors really blew up because now that we were online, we could have people just outside of Columbus. We had experts who were willing to come to our little meeting of 20 people online and talk to us because no one had anything to do, right? You couldn't do anything during the pandemic. So we really grew. And we spent the first year trying to keep it down to as few people as possible because I was still thinking mastermind. but soon we realized that there is so much interest and so many people that are wanting to learn how to invest this new, better, more efficient way. And so Left Field Investors, at the end of 2020, we had 50 members, which was on purpose. We tried to hold it to 50, and then we realized we couldn't. So now, we have over 2,000 members, and we just sold the company to BiggerPockets, and we're starting the company PassivePockets, which is going to be basically all that Left Field Investors is going into PassivePockets, and we're now going to have the resources to really grow the community, provide the tools, provide the connections, provide all the things that we wanted to do when we were Left Field Investors but didn't have the resources for. So that's a long story to my life story, I guess.
So Alaska? I didn't know you were from Alaska.
Yeah, that's where I grew up. I don't know why my whole family's from Ohio, but my parents, when I was 6, we went on a 3-month camping trip, and from Arizona, where I was born. My parents got out of Ohio, but everyone else was in Ohio. And they traveled around the country, and we ended up in Alaska. And then someone that he worked with in Arizona sent him a job application just as a joke to work for the state of Alaska as an accountant. And my dad interviewed, took the job, and we never went back to Arizona. We had a house full of furniture there, and just they couldn't sell it, interestingly enough. And so we bought a house and lived there for a year with no furniture. I slept on a bunch of boxes stuffed with newspaper. That was my mattress, and it was probably the best year of my life. It was awesome.
And you were 6?
I was 6, at the time. Yeah.
Do you have siblings?
Yeah, I have an older sister. She's 2 years older than me.
And she also took it the same way, the best year of her life as well.
Oh yeah, I think so. Like my mom we didn't have a car. We only had the motorhome. So my mom would drive my dad to work in the motorhome, and then drive me and my sister to school and drop us off in the motorhome, and that was how we got to school. We were the kids that got dropped off by the motorhome.
And you slept in the motorhome?
No, we bought a house. We just didn't have any. We couldn't afford any furniture because we couldn't sell our Arizona house, and that's why we just slept on the floor, and it was fantastic. We didn't have a TV. It was awesome. It was a great year.
That sounds amazing. Wait, and did they end up selling the Arizona house at some point?
Yeah, eventually we sold the house, and then we loved Alaska. My dad didn't like his job, so over the next 2 years, we went to Missouri, and then we went to Minnesota, and then my dad found another job in Alaska, and we moved back up to Alaska for good. And
wow.
We just loved it there. Yeah.
So when did you leave Alaska? At what age?
Well, when I went to college, I went from Alaska, and then
your entire childhood basically was in Alaska.
Yeah, and I came back after not after college, but college summers and winter breaks. I came back to Alaska, and then eventually, when I graduated and got a job, I moved to Philadelphia. So I haven't been to Alaska other than to visit since, but it's a great place.
Yeah, it's on my bucket list. I've never been to Alaska before. Sounds like an amazing place.
It is. It is.
Is there a real estate market in Alaska, or is it not really?
There is. I know nothing about it, but I do know that there's a podcaster who's fairly well known. His name is escaping me now, but he lives in Alaska. I'd have to think of his name, but he does some business up there.
I've never heard of a GP or a multifamily or a real estate guy raising money for a deal in Alaska. Maybe they just don't want to look at that area because it's just too far from them.
Yeah, I haven't seen that either. I know there's a guy who lives there and does a podcast, but he does all his investing in the lower 48, as we call it.
That's funny. A little ironic, but yeah, cool. All right, so college and financial advice. It's like really interesting because like I do feel like there is some sort of correlation between being a teacher, financial advisor, and building a community. And that is to educate people, right?
Yes.
Obviously, teacher is a teacher, and financial advisor educate people on their finances, and left field is sort of a subset within that, on specifically around passive real estate. And I totally understand that. We had this conversation, right? That people don't understand that real estate investing, the active part, is active, and no one can convince you that it's ever passive. Even if you have a property management firm, like it's fine to do that. You just have to understand the mindset that you need to be in, right?
Yeah, I mean, I thought I was a passive investor when I was, buying small multifamily and single-family homes and hiring a property manager. I thought I was passive. It was not passive. Like you said, I have to manage the property manager. There's so much to do. True passive investing is when you can just give someone else money and they go do all the work, right? And so but I didn't recognize that at the time. Now looking back, I'm like, that wasn't passive at all.
Yeah, I mean, passive, and this might be an interesting conversation to have because I have this whole philosophy about passiveness and investing in general, I think it's a spectrum. I don't think it's not binary. It's not 0 or 1, right? It's a whole spectrum of passiveness. And I believe that if you have to spend 2 times the time on an investment, you have to make at least 2 times the return. Because people always talk about balancing risk reward, but you have to add in the time or the passive activeness that goes into that as well, right? Because when you think about it, if you're flipping homes, you're making amazing profit, right? But how much time are you spending on that? Like, I'd say, I don't know, at least 50, 60 hours a month.
Oh yeah, it's crazy how much time.
But if you're doing LP investing like you and I love to do, you're spending 10 minutes a month. Like, it's all on the front end of it, like just finding those good operators, which is the whole issue on its own that we can talk about. But I think because like if you want to be a real estate investor, you can be anything from a flipper, and there are people that I know that define buying a publicly traded REIT also as real estate investing. There are people that define it as such. Now, if you do define it as such, that's like the ultimate passiveness, right?
You can't get more passive than that.
You can't get more passive, but then the question is, between that and an LP investor, I don't think you spend that much more time, but you do increase your returns massively because you have to factor in the tax benefits and the cash flow and the correlation with the actual asset, which a publicly traded REIT isn't usually correlated with the underlying asset because of the stock fluctuates based on supply and demand. But I think the whole world of passiveness, and Left Field is about that. PassivePockets will probably be about that. It's such an important emphasis to talk about when you think about investing in this asset class that's called passive investing as an asset class, right?
Yeah, I can't agree more. I mean, REITs are super passive. I think they're more passive than the LP type investing we do. I think the main benefit you get is liquidity. You get instant liquidity, but you don't get any tax benefits. I don't know. I don't invest in REITs, but the one step down where you get all the benefits, but I think you have to spend a little bit more time as an LP investigating and making sure the sponsors are the right sponsors, because it's so easy to get in and out of a REIT. The difference is in passive investing, they're long-term illiquid assets, and you really need to make sure that you hire the right operator, because in a REIT, if you make a mistake, you can get out of it, right? If they do something you don't like, you can get out of it immediately. But now that we're finding out some of our deals are in trouble, you're stuck. There's nothing you can do.
Well, let's touch on that as well, like liquidity. All right, as a subject, I'd argue that liquidity is, from a technicality standpoint, it's liquid, but from a realistic standpoint, if you're investing in a REIT that's fraudulent and they lose money, that REIT price will drop.
Yes.
And so the liquidity is useless because you just lost 50% of its value, let's just say, right? So who cares that it's liquid if you lost 50% of your value? If you're invested in a private fund that value goes down and you say, I want to sell it at a 50% discount, there's a good chance you can sell it. You can liquidate that, right? And I'm not saying it for sure, but there is a chance you could.
There's a chance. I mean, I think it's difficult because you got to find someone who's willing to buy into a deal that is losing money, right? And a lot of these are, if all the equity's gone, you're not going to be able to sell it for 50%. I think when I look at it, it's less about the ups and downs. I think it's more for me is when I got into passive investing, I went all in. I was like, I love this. The returns are great. The taxes are great. It's everything I've wanted to do. And then I realized that one of the big mistakes I made was not putting money aside liquid in case I wanted to, do something else, right? And so I think when I talk about liquidity, it's one of the mistakes that I made is you don't want to go all in because you don't have liquidity, and maybe you want to, I don't know, buy a house somewhere, a vacation home. Okay, well if you're all in these LP investments, it's hard to sell those. It's hard to get out of them, and so that's my new kind of look is, okay, I want to be as passive as possible. I want to have as much into real estate as I can, but I also want to keep a bucket of money somewhere that I can earn a return that is more liquid than I would get from my LP return. So I just am referencing the mistake I made of going all in.
So let me ask you this about liquidity, right? That specific example you gave. What would you do with that liquid cash at the moment?
Well, that's a great question. I think I have some in the market, which I used to say I'm not doing anything in the market. But because I want some return, I put a little bit there. And then, now that you can put it in a savings account and earn 5%, I just put some of it there, right? Because, 2 years ago when times were good, there were some investments that were paying 6%, right? The debt stuff that you could get were paying 6, 7, 8%. Well, now I can get 5, and there's very little risk. So that's what I'm doing now. It depends on interest rates, but that's the challenge, right? We all talk about if you're holding money now, at least interest rates are higher. But what do you do with your dry powder, right? Where do you put it if you haven't allocated it yet, or you want to put some in emergency fund? So I have some in life insurance, I have some in the stock market, and I have some in just a regular money market account that pays 5%.
Yeah, I think the decision of where to put it now is a lot easier than it used to be like 2-3 years ago because of that ability to put 5.5, APY is like,
yes.
It's not that far fetched. It's like pretty common now. And so it's like the decision for where to park that liquidity is a lot easier than it used to be. And that's why you made different decisions, I think. There's no place to put the money that grows. And so it made sense to put it in syndications all the time. But now the whole mindset is different because you can't.
Yeah, and it took me a little while to figure that out, right? I knew bank accounts were paying 5%, but it took me a while to be like, okay, why would I put it in something that's going to pay me 8%, an 8% debt fund that's locked up for a year plus that has risk when I can put it in a 5% where I can have access to it any time? So, not that I would take all of my 8% money and put it into 3%, but, you have to think of those things. And as the market changes, as times change, perhaps interest rates are going to start going down now, and then that's great for the real estate part, but then you have to think about, okay, where do I put my dry powder? Where do I put my liquidity? That'll make the decision tougher. I don't think we're ever going back to 0 or 0.25% again. So, maybe it'll be a little bit better, but when savings accounts are hitting 3 or 4%, you're going to have to reevaluate.
I totally agree. I think there's so many people that are delusional thinking that the market for the past 10 years, like the ZERP era, as they call it, that's the abnormality, not where we're at today. Like this is how the world should, like, not the world, but like, yeah, there should be, a zero risk return on, savings because they want people to save.
Yep.
You want to control inflation. So I do not think that their interest rates are going to go down to what they used to be. They might stable down. I don't know, probably 4% or whatever it is. But it's never going to go down to 0. And so if it won't go down to 0, there's always going to be alternatives to park cash to create those types of like emergency funds that are zero risk or almost zero risk, right?
Yeah, I completely agree with that. If you look at it in the 80s, I wasn't investing then, but interest rates were 12, 15, 20%. The mortgage on my parents' house is probably 18% or something crazy like that. I don't think we're ever going back there either. But that was normal. People still made money at that, right? When interest rates are 8, 9, 10%, people in real estate found ways to make money. So when I look at it, the difficult part we're having here is when you go from 10% interest rates to 15%, that's 50% increase, but it's 5% more. But when you go from 0.25 to 5, that's 20 times more. So when you look at it that way, that's why we're having so many issues in the market and trying to figure this stuff out, because you just had a 20x on your cost of money, where before people were used to a 0.5 or just really smaller amounts. When you go from almost 0 to 5%, that's huge in the amount of cost that it takes to buy the money that you're trying to get.
Yeah, and on a macro scheme, like when you even think about 4 to 5%, people say it's only 1%. But no, it's like 20-25% increase. Like that's insane.
Right.
Like people don't understand that because they look at the absolute number. All right, cool. So yeah, we can dive into different avenues of this conversation. I want to move on though to more personal related stuff. All right, so
sure.
So you had enough of the active stuff that I totally understand. You went into passive and started investing in syndications, made some mistakes, right?
Lots of mistakes.
Do you think that your strategy for obviously from like the holistic asset allocation, I understand that, but specifically within real estate, specifically within LP investments. Have you changed your strategy now?
Oh, absolutely. Yeah. I mean, when I first started, I had no clue what I was doing, which is why I needed friends. I needed a community. The first time I invested in one, I'd never done this before because I worked in the corporate world where whenever you go on a business trip, they pay for it. You got a credit card, nothing's on your own account. But I signed up for a real estate conference, paid my own money. I had to pay for the flight, pay for hotels. It's very strange for me because I'd had corporate people paying for everything for me. And so it was a huge jump for me to spend all that money to go to a real estate conference. I wouldn't think twice about it now. I'd just do it. But then it was a big deal. And it was, I met it was for a syndication conference or a bunch of GPs there. And I just assumed that if they were there, that they must be fantastic operators, right? They just must be the best of the best, which is stupid looking back because what happens is operators pay to go there to find people to invest with them. And that was me. I had a rollover 401k, an old 401k that I rolled into a self-directed IRA, and I had a bunch of cash, and I just started handing it out. I'm like, you're an operator, here you go, here you go, here you go. And, I got in some really bad investments. Some were okay, but some were bad. And because I didn't have a clue what I was doing. And so then I had to figure out, there's two things I had to figure out, right? One is, how do you find the right operators, vet them, and invest with them? And then to your question is, how do you decide where you're going to allocate that capital? Because once you decide to put it into real estate, there's a whole bunch of asset classes and even sub-asset classes of where to put it. And continues to be a challenge for me to try to figure out where to put everything and how to even look at it. And I'm not trying to, I don't want to plug Visor too much, but that's one of the tools that really helps with this, is because before it was Excel spreadsheets all over the place, and now I can look at everything and say, okay, I have so much in self-storage, I have so much in multifamily, or I have so much with operator A, B, and C, and you can really start to look and then develop a strategy, because it's important to diversify your asset class, right? Most people start with multifamily, and if you were all in multifamily over the last 5 years, you're losing money now because half of those deals or more are with adjustable rate bridge debt that, could be having problems. Whereas if you diversified, did some self-storage, some industrial, some office, and did all, a bunch of different asset classes, you're in a much better situation, because industrial is fine. Office is really bad, but the one that I invested with, these A-class properties, they're fine. And so it just depends. That's why I think diversification within the real estate syndications is so important.
So you're saying that your biggest lesson is being more diversified.
Yeah, well, that and the liquidity thing we talked about. But being diversified.
But within this asset class of passive investing in.
Yes. But what I'd like to do, and I haven't really taken the time or had the time to do it, I want to be more intentional with my diversification. What I did, before, when I was just managing everything on random spreadsheets, it was, well, it doesn't feel like I've done a self-storage deal lately, or it doesn't feel like I've done, a car wash, so I'll do a couple of those. But I had no idea how much capital I have in each one of these buckets. And so, now I'm starting to use the tools available. Visor is one of them, where I can really see, okay, I have so much in these asset classes. Then I can say, I have so much in these markets and these operators. And then you can intentionally diversify in a way that really makes a difference. And you can kind of think, okay, industrial's doing great right now, so maybe I put some more in there. But I also don't want to go too much into industrial, because what I've also learned is that there are peaks and valleys, right? There's market cycles. And the time you learn that or remember that is when markets are down. No one was talking about market cycles 3 years ago, because the market cycle was an arrow straight up. And it was just put as much capital as you can in, because you're just going to get that back. You're going to get twice as much back in 2 years, right? We're not in that anymore. So you really have to be a lot more careful and intentional.
Yeah. And you need to invest with operators that back then, you just threw a rock and you'll hit a good deal just because of interest rates. Now, it's hard to find, because that's how it should be. It should be hard to find good deals.
Absolutely.
Right. All right. So Left Field went up and scaled and gave you and all your co-founders and all the members more understanding, teaching them the lessons learned and finding better deals and analyzing deals better and bringing in operators and creating partnerships and going to events, and that scaled and scaled. At what point did sort of BiggerPockets and Left Field start to sort of you're starting to see like there's a synergy there?
Yeah. So, well, we'd been, Left Field Investors. It was a great community, and it was something that we wanted to continue. We just didn't have the resources, and we weren't in like startup mode, right? Where we'd done 4 years just barely getting by. It took us a year and a half to figure out we had a business because it wasn't intentional. And then, the next couple of years we were kind of making sure everything worked and doing different things with the tech side and the website and all that. So it took us a long time to figure out, okay. And then once we got to the point where like, oh man, there is so much demand for this. We can really grow this and do something great. By that time, frankly, we were we were a little bit burned out and we didn't have the resources. And we'd always said when we were joking, when we started this thing accidentally, like, oh, wouldn't it be funny if BiggerPockets bought us someday? Because they are, the biggest real estate community in the world. And so we started thinking, okay, we need to either go out and get some capital, inject it into this company, devote, a bunch of time and years to a startup effort, or we need to sell to somebody. And or we need to kind of shrink it up and just make it a smaller community where it isn't taking up so much of our time and effort. Because part of the problem was we weren't paying the guys for what they were worth. People were working way too many hours and barely making almost no money. So it was really difficult. And I got introduced to BiggerPockets, and it was funny that I was talking to them, and they said, well, we should think about a partnership, or maybe sometime down the road, maybe we could talk about buying Left Field. And hung up the call and was like, yeah, that's great. And sat there for a few minutes. I'm like, why don't we just talk about that now? Called him back and said, let's talk about now. And it was a 6-month plus process to get it done. But there's just so many synergies, right? What we have is we have some expertise. We've been working for 4 years with operators, with LPs, and optimizing a community that works for everybody. It's not perfect by any means, but we've learned, we've made a ton of mistakes, and that's how you learn. Where BiggerPockets, they have resources, they have a huge community of 3 million people, but they don't know what they don't know about passive investing. Even if some of them are passive investors, they don't know how the community works. So it's a perfect match where they can use our expertise, shortcut the system, and not have to go through all the learning, growing pains that we did. Where for LFI, it's fantastic because we're going to get resources where they can actually do stuff. We had on our list a sponsor reviews. That was on our to-do list for 3 years. We finally got it done, but BiggerPockets could do that in 3 months, right? So I think there's going to be change, and change is scary. And the change is that now we're with a bigger company, and the awesome thing is they're going to have all these resources so we can really do some great things for LPs and for our operator partners. The scary thing is we're going to have a lot more members. And the thing I'm most proud of about LFI is the culture that was built by our community members. And, when the announcement came out, we have a forum at Left Field Investors, and there's a bunch of people talking about the purchase, and almost to a person, they said, we love Left Field Investors. We're excited about the opportunity with PassivePockets. I sure hope the culture stays the same. And so we recognize that at Left Field Investors, and BiggerPockets, PassivePockets realize that, and the culture is the thing we're most protective of and most concerned about keeping.
I have a difficult question around it because it is a big deal. You guys put your sweat into this for 4 years. And how many founders are you?
6.
And I know you're the one who took point, but out of the 6 of you, was it unanimous? Let's do it? Or there's some that said, wait, well, is this a good idea? Should we maybe try some more? Maybe shop the market? Was it let's do it?
It was a little bit of both, to be honest. So we have 4 members that were active, working day to day in the business, and 2 that have, their own W-2 jobs and were just helping out when needed. So, and those 2 were fantastic. They were like, you guys, you're working in the day to day. We'll go with whatever you said, right? So we had 2 that were fully on board with whatever we decided. But the other 4, when we were negotiating and trying to figure out, okay, what's the payout, and also how do we make sure the community stays the same, there were some conversations about, okay, what are our other options? And what we realized was that none of us had some of us had energy but no time, and some of us had time but no energy to really do this the way that it needed to be done to scale it. So we knew we needed a partner, and we knew BiggerPockets was by far the best partner that we could find for this. And there aren't very many options, right? I mean, there were operators that would have bought us, but that completely changes everything, right? Because now we're owned by an operator, so everything's a lot, much more biased. So there were some difficult conversations, but we realized, like, the main thing we wanted, of course, we wanted a payout for us for the work that we've done. But our main concern is we've always tried as hard as we could to put the community first. And when we had revenue opportunities or sale opportunities, we always said, okay, is this going to benefit our community? And if it wasn't, we didn't do it. And so we did hold true to that with BiggerPockets. But there were some times where we're like, okay, if we don't do this, if we don't get the numbers we want, or if it's not working out the way we want, what are our other options? And we kind of realized that our options were team up with someone great like BiggerPockets, or really reduce the size of the community and the time that it would take to run it. Because we had 2 people working full-time, more than 40 hours a week, but full-time. And then 2 guys who said they were working part-time, but they were also pretty much working full-time. I mean, you know how it is when you're in the startup world. We're just doing everything. So I don't know if that answered the question, but
no, it does. It does.
We were all in. We were all in with this at the end.
Yeah, and I appreciate the openness. It's super interesting to see how companies go through this acquisition M&A process. Every company goes through it differently, but there's always a conversation around it. It's never like, yeah, everyone signs off and it's good. There's always a conversation. I think it's important because that conversation means you guys care. And I think that's like the core of it, right? And so,
well, it was also, part of it was, working with the folks at BiggerPockets that we were working with. They really understood the culture of LFI. They took the time to understand it. And once we were confident that they weren't just going to take our brand and run and treat the community poorly, once we found out, okay, they really understand it, and we were sharing things like, hey, they had some ideas of how they thought LPs were, and we're like, no, it's a little bit more like this. And they were so open-minded and willing to learn from us that gave us confidence that, although they're a big company and they know what they're doing in their niche, which is much bigger than passive, they understand that there's some things they can learn in our niche. And because they were so humble about it, that really made everything a lot easier.
Awesome. What are the next steps for you guys? Obviously, I think we spoke about it. You do want to retire at some point for real, right? So
yes.
How does that look?
Well, so, that was the one thing, because the way we set up Left Field Investors, one thing we tried to do is it was focused, because I was the one that was full-time for the longest. I was kind of the face of it. And before the BiggerPockets thing came up, we realized we need to get some other people involved, so it's not just Jim and Left Field Investors, but it's Jim and Chad and Ryan and Pat and Steve and Sean and everybody. So everybody had some visibility, because my concern was that if we sold it, they wouldn't want it unless, the person who was running it came along for the ride and a long ride. But BiggerPockets, again, ideal partner, they have the resources to find people that can fill some of these spots. And so they don't need us long-term. I think some of us might end up being there long-term. But my plan is to help with the transition in whatever way they want for the next 6 months at least. And, there's going to be the Pat and Ryan and Chad and I, we will all work there 3 to 6 plus months and then kind of reevaluate. And if we're liking working there and everybody's happy and PassivePockets still needs us and wants us, then some of us will stay. And if they don't, then, we'll go our own way. And I've told PassivePockets that, I was semi-retired when I started Left Field Investors, and I didn't start it on purpose. And I am ready to retire. And retire for me is to become a full-time passive investor. That's what I'll do with my time. But Left Field Investors, as you said, it's my baby, right? I want it to grow and prosper. So I'll stick around as long as they want me and as long as I'm needed to make sure that the community is going to go forward in a positive way. And if that's 3 months, fine. If it's 6 months or a year, that's fine too.
Have you already found a house in the mountains?
Yes, we did. We did that last summer. We accidentally found a place in Colorado. So
accidentally, by the way.
Yeah, we found it sooner than we wanted to, but yeah, we're going to be moving to Crested Butte, Colorado.
Is that close to Denver?
It's about 4.5 hours. It's kind of a dead end road. It's what they call the last great ski town in Colorado. Because it's on a dead end road, it's really hard to get to.
Okay.
So they don't get the big crowds. But it's 10 miles from Aspen, if you're as the crow flies. But it's like a 4-hour drive because they're not close to each other on as far as roads go.
Yeah, we're gonna have a helicopter, right? Make enough passive.
I hope so. That'd be awesome.
Awesome, man. Really great stuff. I really appreciate the conversation. Is there anything you want to add just to sum it up?
I would just say, the transition from LFI to PassivePockets is going to be super interesting. And if you are an LP investor, a limited partner interested in investing in real estate syndications, I always say this, you need a community. It doesn't have to be left field investors or PassivePockets, although I'm biased and I think those are the best communities. But you need something, because if you walk out your front door and you talk to your neighbor about finance, they're going to talk about the interest rate on their mortgage, the 401k, and maybe some stocks they might own. And that's it, right? And then you're going to say, well, what about real estate syndications? And they're going to look at you like you're nuts. And so it's really hard to find these investments and to learn how to be a good investor. And so my strong belief is that you need a community, and you need a community where the culture of that community fits your personality. So if it's not PassivePockets, then go find another community that works for you. But that is the way to become successful in this niche area of investing, I believe. So that's my strongest belief.
That's awesome. And I'm happy to be a part of you guys in all that journey, and we'll see what happens with PassivePockets. Thank you so much for joining, Jim. And to everyone else, thank you for joining us and listening into this interesting conversation with someone I admire. That's it for now. Thank you for joining Advisor Visionaries, and until next time, keep investing wisely and passively. Have a great day.